Hey guys, it's Jess. And today we're gonna do a quick market update because honestly, there's a lot of noise going on right now all over social media and the media, and it's really hard to know what's a true signal. Bitcoin is at $67,000 as of the time of my recording, which is down 48% from its all-time high of $126,000 back in October. And the Clarity Act stalled in the Senate. The dollar is weakening and stocks just hit new all-time highs while retail sales are flat. And if you're confused about what any of this means for your crypto holdings, well, that is what we're gonna cover today. So let's cut through the noise. Here's what actually happened this week, what it means, and why this looks like textbook accumulation phase behavior. Let's get into it. So let's start with price. We know that Bitcoin is trading around $67,000 as of this morning Central Standard Time. So that's down about 1.5% in the last 24 hours. And yes, we're still sitting roughly 48% below the all-time high we hit in October of last year. Now, if you only looked at the price, you would think institutions are running for the exits. And yes, I know that was the name of my video yesterday, but that's not what I meant by it. And you would have to go watch my video to understand what I was really saying there because it still holds relevant today. But here is where this gets interesting. So let me paint the scenario for you. Because as of last Friday, if you saw my video, you would know that on February 6th, US spot Bitcoin ETFs saw $370 million in net inflows or new money coming into the ETFs. So that ended a 3-day streak of outflows. And BlackRock's IBIT alone captured $230 million of that, about 62% of the total. And here's the kicker. IBIT is currently the 6th largest ETF by flows as of last year's data, 2025. So that's not the 6th largest crypto ETF. That's the 6th largest ETF, period. And it's sitting right alongside Vanguard's S&P 500 tracker and other massive traditional funds. And this is the part I want you to pay attention to because IBIT is showing negative returns year to date. And it's the only fund in the top flow leaders that's posting losses. Every other top performing fund by inflows is up double digits. So we have a scenario where institutions are pouring billions of dollars into an asset that's down 48% from its all-time high and posting losses on the year. So that's clearly not panic. That's accumulation we're seeing. And we hear from Bloomberg's intelligence analyst Eric Balkunis calling this, I quote, a hodl clinic, meaning longer-term allocators are treating Bitcoin ETFs as strategic holdings, not momentum trades. They're buying the dip. Now, let's contrast that with what we saw earlier this month. February 3rd, Bitcoin ETF saw $270 million in outflows, and Fidelity's FBTC led the retreat with $149 million leaving. But BlackRock's IBIT ETF, well, they still saw $62 million in inflows that same day. So what's happening, you might ask? Well, as I've said in past videos, retail psychology is simply flowing through institutional infrastructure. Some institutions are selling on fear because they don't know what they're holding, they're not as educated, while others are buying on conviction and what they know. And BlackRock is in the latter bucket. They keep buying because they understand Bitcoin's intrinsic value, or it seems like a learning curve is happening in real time, as I've been saying. But now let's talk about the Clarity Act, because this is where the story gets real, and this is what you'll see all over Crypto X. The Digital Asset Market Clarity Act passed the House, we know this, back in July. I covered this extensively in yesterday's video with strong bipartisan support. The whole point of this bill, as I was saying, is to finally answer the question in terms of who regulates what in crypto. Is it the SEC or is it the CFTC? And it's been stuck in the Senate since then. And in January, we know, just as a quick recap for you, the Senate Banking Committee was supposed to mark up the bill. basically move it forward for a vote so it can get to Trump's desk so he can sign it into effect. And well, if you've watched my videos, you would know they delayed it with no new date announced. We just know they have until the end of the month to get it together. And the reason it's been held up is because banks and crypto firms are in a fight over stablecoin yields. Banks want to ban crypto platforms or exchanges from paying interest on stablecoin holdings. Crypto firms obviously oppose this because it's a core part of their business model. And Coinbase actually withdrew its support for the Clarity Act entirely because of this provision. So, this is where the White House stepped in, and this is where I want to pick up today. We heard Treasury Secretary Scott Bessent held meetings on February 2nd to try to broker a compromise, but there was no agreement. They scheduled another meeting, and on February 5th, Scott Bessent went on record. You could see him, I think it was some news channel, calling what he called, this is what he called it, crypto nihilists. Okay, suicidal people basically in the crypto industry who want no regulation at all, is what he said. And I quote, "It's impossible to proceed without it," he said. "We have to get this Clarity Act across the finish line. And many market participants, aka Coinbase, who don't want it, should move to El Salvador." Now, here's what this tells us. Regulation is coming. The fight isn't about whether crypto gets regulated. It's about what kind of regulation we get and who wins the turf war. And you can actually hear from Jamie Dimon, where he talks about how crypto is the new thing.
Blockchain is real. It's been around for quite a while, but now it's becoming more effective, more efficient because people find ways to do it faster and cheaper, permission or not permission. Smart contracts, I think, will probably be real.
Which leads me to believe that they may, in fact, be striking some sort of a deal, some sort of a partnership behind the scenes. So I will be reporting on this more in the coming days and next week when we hopefully get some sort of agreement. But here's the bottom line. This delay doesn't change Bitcoin's fundamentals. It just extends the timeline for institutional clarity. And ironically, that might be better for accumulation. But now, let us switch gears a bit. Let us zoom out to what's going on in the macro scene, because this is where things get very interesting. We see that the US dollar index, okay, the DXY, is at a 96.8 this morning. So that's down about 10.4% over the last 12 months. And just this month alone, it's down over 2%. Why? Well, there's a few reasons. First, weaker US retail sales data showed consumer spending basically stalled in December. That's strengthening expectations for Fed rate cuts. And markets are now pricing in 3 rate cuts in 2026 this year, up from just 2 rate cuts expected just a week ago. So you see how fast things can move and change. And then secondly, there are reports that Chinese regulators advanced financial institutions to limit their holdings of US treasuries. They didn't say sell them all, they just said reduce concentration risk. But that's a pretty big signal about foreign demand for dollar-denominated assets. Meanwhile, US stocks just hit new all-time highs today. The S&P 500 and Dow both posted record closes. The Nasdaq jumped nearly 1% after a strong jobs report showed 130,000 jobs added in January, about double what was expected. So now let me connect all the dots here. On the one hand, the dollar is weakening. On the other, the Fed is expected to cut rates. All while foreign buyers are pulling back from US debt, and stocks, well, they're still rallying. Yeah, this is what late cycle behavior looks like, even though we don't know exactly how long this cycle is. And Bitcoin is sitting at around $67,000. So it's basically flat while all of this is happening. Now, a lot of people may be asking, maybe this is you, and maybe you're wondering, see, Bitcoin failed as a hedge against dollar debasement. But that's not what's happening here. Bitcoin isn't failing. Institutions just don't understand what they own yet, as I have covered extensively in past videos. They're still treating Bitcoin like a tech stock, something that goes up when risk appetite is high and something that goes down when people get scared. But Bitcoin, we know, is provably scarce digital money. It should trade inversely to the dollar over time, and it will over time. The fact that it's not rallying right now while the dollar weakens just means we're still in the educational phase. We're still going and observing the institution's learning curve. And that's exactly what we've been talking about for months now. And if we take a look at the ETF flows, well, we can see some of this learning curve coming into effect and happening in real time because BlackRock, as I was saying, is accumulating and long-term allocators are also buying Bitcoin. The people we see that understand or are slowly waking up and understanding the macro setup, they are positioning themselves. And the people who don't understand yet, they're panic selling because the price is down 48%. That's all they see from the all-time highs. And then, unfortunately, they're learning like we all had to, and they're buying back in after they see that BlackRock is still accumulating. So they're still chasing FOMO. And this is not a bug, unfortunately. This is the feature. This is how generational wealth transfers happen from the impatient to the patient, from the people who treat Bitcoin like a tech stock to the people who understand or are starting to understand that it's digital gold. So, okay, where does this leave us today? As of now, Bitcoin is at $67,000 and the Clarity Act is delayed, but it's still moving forward, all while the dollar is weakening and stocks somehow are still at their all-time highs. And we see that institutions are still in their learning phase. Nothing has changed about Bitcoin's fundamentals, but everything has changed about who owns it and how they are treating it. So for those of us who understand the macro setup, this is exactly what an accumulation phase looks like. It's not sexy and it's not going up in a straight line. But it's exactly what happens when the world's largest institutions are slowly getting their bearings and figuring out what they actually own. So the good part, the positive side, is that the opportunity hasn't closed. It's just gotten more obvious. So, all right, that's the update for today. I hope it was helpful. Let me know in the comments what you want to see next, what questions you have. And if you're not subscribed, I would ask you to consider subscribing and to like the video if you gained value, because we're gonna keep filtering through all the signals that we see in the media and from the market, and we'll be connecting the dots here so we have a clear idea and map, so to speak, of how to navigate this very volatile market that is also extremely rewarding once you learn more about it and how it works. So I love you guys so much. That's a wrap for today's video, and I will catch you guys here tomorrow.